Okay, Harry, you ready? Want to jump in?
Sure, let's go.
All right, I want to say welcome everybody, and we are live streaming this on YouTube, Facebook, and LinkedIn Live, and of course here on Zoom for all those that are here. I'm Paul Hitchcock. I work at Barth Calderon with Harry Barth. Harry is the founder of our firm and the senior managing partner. We are an asset protection, estate planning, and business planning firm that's been around for over 35 years, based out of Orange County, California. And really excited to have Harry here for this episode of Wealth Protector TV. There's a lot going on coming out of Washington. As Harry will tell you, day by day changes. We're going to jump into it. Harry, what's the update?
Well, here we go. So first of all, thank you. It's good to be with all of you again. I think this is about my fifth update since we started our updates regarding the tax changes in April of 2021. So what I'd like to do is kind of take you on a little bit of a tour of what's happened. Back in April 2021, we had the 95.5 Act, which was, as I said to many of you, was the most draconian measures that I have seen to be implemented and the biggest paradigm shift in the tax code since World War II. And so we had that iteration from the Senate, which I've shared with you numerous times. And then about 6 weeks ago, we had a bill emerge from the House Ways and Means Committee, which is significantly different. So, example, in the 95.5 Act, the $23 million as transfer tax exclusion for a family was moved to $7 million. And the tax rate went from 40% above 23 million to 45 and 50% above 7 million. Then just not only 4, 5, 6 weeks ago, the House Ways and Means Committee came out with a bill. And in that bill, because the Spending and Reconciliation Act was taken from like 3.8 trillion down to 1.7 trillion, now they say we'll reduce it from 23 million down to 12 million and keep the 40% rate. And as we sit today, as of 2 weeks ago, the House Ways and Means Committee, the text of the House Ways and Means Committee bill has emerged. And guess what? It's still going to be at 23 million, unchanged and indexed for inflation. Now, please understand as I go through these various different bills that the House Ways and Means Committee bill, which will be voted on probably within the next few weeks in the House, still has to go to the Senate. In all probability, the Senate is not going to make it worse, but we could have some surprises. So we're still on a daily basis changing, but the changes that we've had are good changes, but they also are a warning that I want to share with each and every one of you. So there we go. Now, income tax rates, personal income tax rates, they were supposed to go up to 39.7, no change in personal income tax rates in the latest version. Capital gains tax rates, which at one point were over $1 million of capital gains was going to be taxed at 39.7%. Then in the House Ways and Means Committee, 25% capital gains rates retroactive to September 13th. And now capital gains rates remain unchanged. Step up in basis, which was supposed to be eliminated, and 1031 exchanges in the 95.5 Act were not talked about, and no change in the House Ways and Means Committee. So we'll still have 1031 exchanges and still have a step up in basis. Elimination of discounts for intrafamily transfers, very, very important. 30 to 40% discounts, lack of marketability, lack of transferability discounts were supposed to be eliminated. And they were supposed to be eliminated on the date of enactment. And in the House Ways and Means Committee after the Senate bill, and in the text of the legislation that was released just a few weeks ago, we still have discounts. Then we have the other issue that we have, very, very important, is there was the attack on the tools that we use to help you move assets from one generation to the next. Basically, the elimination of grantor trusts and other types of tools that we use so successfully to help you. Well, grantor trust was supposed to go the way of the dodo bird on the 95.5 Act from the Senate. They were supposed to be eliminated along with the intrafamily discounts in the House Ways and Means Committee. And in the legislation of the text that is now being going to the House, we still have grantor trust rules that are in effect. Wow. What a lot of legal fatigue, client legal fatigue, what a lot of vacillation. Now, there are changes. Now, a couple things that were in the original bill, and on retirement plans, for example, no more than $10 million to be accumulated in a retirement plan. If you had more than $10 million to be accumulated in a retirement plan, then you had to take the money out of the retirement plan to pay taxes. Well, that was taken out of the House Ways and Means Committee bill, but in the final text was added back in. The other thing that was added back in that was unanticipated is the removal of the SALT cap, the $10,000 cap that we have on the deduction of state and local income taxes against federal taxes. This primarily impacted high state tax states, that's California and New York and other similarly situated states. In the version that is at least being considered in the House through the House Ways and Means Committee, that $10,000 cap has now been raised to $80,000 at least for 10 years. It's welcome news in New York and California. Now, so what does all this mean? And first, let's also take a little bit of a moment to see what is in the bill that we voted on, and then go to the Senate for modifications and or changes, then back to the House before it goes to the president for signature. So it's a whole bunch of not a lot on the areas that we have been very, very concerned about over the course of the summer. And yet, my personal opinion is we are not done. This may change a few more times. And hopefully in my book, it gets booted until next year or the year after. Remember, the 2017 Tax Act expires automatically on December 31st, 2025. So our $23 million state tax exemption will move to about $12 million then if it's not accelerated. But here's a point before I tell you about what's in the act that's very important. All of the issues that we've been discussing all summer, all of the issues that we've been working on together with our clients are still in effect. All of these issues are on the radar screen of the government. The idea that wealth is concentrating in the hands of a small number of families is still on the radar screen of the government. Income inequality is still on the radar screen of the government. But politically, they would not have been able to perhaps get the infrastructure bill through, or unable to pass a reconciliation bill if they were going to do these wild modification in taxation. That doesn't mean for 1 second that in 2022 or 2023, that we will see the Tax Reform Act of 2022 or 2023, and all of the issues that we've all worked so hard on reappear for consideration. The government seems to feel that many of the tools that we use are considered to be abusive, and they target trusts, and you'll see that in a minute in so many different ways. So at least, thank God, at least for the moment, may change in 2 weeks or 3 weeks, and I'll be back with you again. Things seem to be a little bit better on that front. So what is in the bill that is moving through the House right now, and how can it impact us? Well, some of it is interesting, that to help pay for the $1.7 trillion social spending bill is going to be the imposition of a 5% tax, an additional 5% tax on all people who earn $10 million a year or more. Okay. I don't think that that hits much of our constituency, but for anyone earning more than $10 million a year, that is a part of a 5% increase that we have. And you'll also remember that we were going to have a tax just on billionaires. You also remember we were going to have a tax, a wealth tax. It's crazy. How does one measure every year our wealth and evaluate it every single year? And without even a transitional event or an equity event, we have to send money to the government. I don't think that was going to be constitutional anyway. All of that's been eliminated. Also been eliminated, for example, in the bill was every bank account of $600 or more in America, the bank was supposed to report all the income in and all the expenses out of that bank account. To me, unreasonable search and seizure without probable cause. The banks pushed out. There was an uproar, so they raised it to $10,000 because everyone's going to cheat who has $10,000 in the bank. So we had to look at all the income that went into the bank account and everything that went out of the bank account. The IRS had the ability to scrutinize that. Constant, consistent audit. That's gone away as well. But part of that has survived. So let's talk about the part that has survived. As part of the bill, which is moving its way through the House, that we think will pass the House and may or may not survive the Senate, depending upon how the Senate looks, we have a scenario where the administration wishes to invest $89 million in the Internal Revenue Service to modernize its equipment and increase the number of field agents so we can have an increased number of audits and more comprehensive audits from the Internal Revenue Service. Now, the interesting fact is they believe by investing $89 million in the Internal Revenue Service, that would generate $400 billion worth of revenue for the government, inherently saying that we're all tax cheats. Everybody who has any money is trying to cheat the government, that the amount that is owed is not the amount that's being collected. So we better audit very, very carefully. So we've heard this before. I've been doing this for 50 years. It's kind of cyclical, and hopefully that will be modified in some point. I don't think that everyone in America is trying to cheat the government, and it feels terrible for everyone to be kind of considered to be a cheater. Now, on the other front of the new, there's going to be tightened wash sale rules and cryptocurrency controls that are being put into effect. And for large corporations, there will be a 15% minimum income tax, kind of now this global, all corporations will pay at least 15% minimum tax. So large corporations don't get away without paying any tax at all. So in addition, there's one other minor thing for those of you that may have original issue 1202 stock that's not taxed on sale. That has changed if this is adopted, that only 50% of the gain will be eliminated rather than 100% of the gain on 1202 stock. But here's where there's one major change that really we need to take notice of. And that is, in the past, for all of us, for quite a while now, started during the Obama administration, there has been this 3.8% Medicare surtax on passive income if the family has earned $400,000 a year more. So if your adjusted gross income is $400,000 a year, and you have some passive income, interest, dividends, things where we're passive real estate. In addition to the regular income tax we would pay on that passive income, we would also pay an additional 3.8% surtax. In this bill, they changed the rules there. And the rule change here is significant. They're basically saying the same thing. They're basically saying $400,000 single, $500,000 marriage. So the marriage penalty is still there. Now that 3.8% surtax is going to apply not only to passive income, but to active income as well. So the pass-through income that we are receiving from LLCs, partnerships, and S corporations, if we are over $400,000, we'll be paying an additional 3.8% income there. And very important to understand that for trusts, that 5% threshold, that 5% tax for people earning $10 million a year, for trusts and estates, that 5% will kick in, extra 5%, when trust income reaches $200,000. So there seems to be a giant disparity between income being earned, call it $10 million, but only $200,000 from a trust, which goes to the attitude that I've been saying all along, that the government believes that the utilization of trust that we've had for the last 150 years subjects ourselves to abuse and other issues and problems, when these are very, very important tools in intergenerational wealth transfer. So what does it all mean, and why am I here? So why I'm here to talk to you about this is that, yes, this is changing on a daily basis. This was the latest change. To me, it was favorable. Will it change again when it hits the Senate? Most likely, and hopefully better, if not favorable, and not more draconian as it was submitted back in April 2021, which to me was horrific. However, the takeaway is that each and every one of us should take advantage of everything that we have now, right? We should do some planning. We should continue with our intergenerational planning. It's extremely important because I am not so sure how long the tools will last that we currently have to help move wealth from generation one to generation two. It appears that it's on their radar screen, and it appears, I think it will be back. It'll be back in 2025 anyway. So it should be strategy and tactics, plan, take advantage of what we have now, take advantage of the interfamily discounts, take advantage of grantor trust, take advantage of our high gift rates that we have. We have them. We should use them. It's beneficial for families. We had a scenario where about 15 years ago, we transferred $7 million into a trust for a family. That trust blew up to now be $100 million, and it completely escapes estate taxation for generations to come. Just an example of the magic, what can be done with the tools that we have today. And with that, this is where I wanted to get to you. It's going to be a short one today, and we'll be back to you tomorrow if needed as things change in the world of Washington. Keep you informed, keep planning forward, and thank you so much for joining with me today. We really appreciate it. Thank you, Paul.
Harry, thanks for being here. Thanks, everybody. And for those that showed up late in the chat, there's a way to get one-on-one with us for a complimentary assessment of any planning issues you have going on. Harry, we'll see you next time.
You got it. Thank you.
All right. Bye, everybody.